Chapter 5, Part 2. This is where we're going to start looking at the sales part of our inventory. All right, so again, we're adding a couple new lines into our income statement. We're going to see it listed as sales instead of service revenue. So we're originally going to see sales minus discounts minus returns and allowances. That gives us net sales. We're going to subtract out cost of goods sold, and that gives us our new line called gross profit. Again, that's just one of those lines that's going to help us analyze our company better later on. All right, so one very important piece of information is that for any time you have a sale, there are two journal entries we're going to do, two separate journal entries. One of them is going to recognize the revenue we received from selling our inventory. The other one is going to recognize the cost of our merchandise and adjust our inventory on hand. So every time you have a sale, you're going to have a revenue and an adjustment of inventory. All right, so here's a sale without a discount. So it says Z-Mart sold $1,000 of merchandise on credit. The merchandise has a cost to Z-Mart of $300. So we're selling it to our customer for $1,000, but we paid $300 for it. Remember, the intent of selling a product is we have some kind of a profit margin, right? We are increasing the cost we paid for it and making a profit from our customer. So that's what they were doing here. We paid $300. We're selling it to them for $1,000. So remember, we have two sides of the entries. We have the first one, we have the revenue side, and then we have the cost side. So for the revenue side, we've seen these entries before. We're selling on credit, so we're going to debit accounts receivable. This time, instead of service revenue, we're going to be crediting sales. That's our first part. Then we have to adjust for the cost side. To do that, we're going to use a new expense account called cost of goods sold. So we're going to debit cost of goods sold for the amount that we paid for it, that $300, and we're going to credit merchandise inventory to reduce the inventory on hand because we've sold that inventory, so we no longer have it as an asset. So we're going to credit merchandise inventory for the cost we paid for it. So those are the two transactions we have to do for every time we have a sale. Just like before when we had purchase discounts, we can sell to our clients with a discount too. We do account for it a little differently, but the process for discounts is still the same. We still have that 2% 10, net 30, and we're going to see how that works now. So if we sold them $1,000 with terms of 210, this time it's net 45. So this is a transaction that we just did where we sold them the merchandise. We sold it to them for $1,000. We recognize our cost of $300. If they pay within the discount period, we're going to use an account called sales discounts to keep track of those discounts. It is a contra revenue account. So it's going to have the opposite normal balance as our revenue account sales. And it's going to be listed as a subtraction from sales to get down to net sales. So if they paid within the discount period, we are giving them a 2% discount. So 1,000 times 2% is $20. So we're going to be reducing accounts receivable by the $1,000 that they owe us. We're giving them a sales discount of $20. So we're going to debit a new account called sales discounts for $20. And the difference between the amount we're giving them as a discount and the amount they owed us is $980. That's how much cash we're actually receiving from them. So we're going to debit cash for $980, debit sales discounts for the amount of the discount, that $20, and we're going to credit accounts receivable for the full amount. If for some reason they did not pay us within the discount period, then they would owe us that full $1,000, and we would debit cash for $1,000 and credit accounts receivable for $1,000. All right, so just like before when we have purchases, we can return things, so can our customers. Our customers can return products to us, and we might also offer them an allowance. So we're going to use an account called sales returns and allowances because we want to track that when that's happening for our customers. So sales returns and allowances is another contra revenue account that we're going to see used, and this is used when we have a return or we're giving an allowance. So sales returns are when the customer is actually returning the inventory to us after we've sold it to them. A sales allowance is when we're giving them a price modification to encourage them to keep the inventory and reduce it to their customers. All right, so if we have a sales with a return allowance, so if it's with that, we have to remember that we have, every time we have a sale, we have 2 transactions. With sales returns, we have 2 transactions too. It's because we have to adjust for the sales return part, but we also have to adjust for inventory. So sometimes inventory they might just be returning it because maybe they bought the wrong color. So that would not be defective. They also might return it because there was a problem with it. And in that case, we might write that off. So here we have a customer returning merchandise that we sold to them for $15 and it cost us $9. So we have the first part of the transaction, we have to adjust for the revenue part, the return of that revenue. So we're going to debit sales returns and allowances for $15 and we're going to credit cash because we're giving them that cash back. If it's not defective, then we're putting it back in inventory. So the part 2 of the transaction is to debit merchandise inventory to put it back in inventory and to credit cost of goods sold to fix that return. If it's defective, and this is where they're saying a part of it is defective, we would put the inventory that is not defective back into inventory. Anything that's defective, we're going to debit this new account called loss from defective merchandise. And then we would credit the full amount to the cost of goods sold. Another option that we could do is give them an allowance. So this says assume that $40 of the merchandise Z-Mart sold on November 12th is defective, but the buyer decides to keep it because we're offering them a $10 price reduction. So they're offering them a reduction in their cost to keep it and sell it to their customer as a damaged item. So we're still going to use that sales returns and allowances account. We're going to debit that and we're going to credit cash because we're giving them that $10 price reduction back. If they had not paid for it yet, we would be crediting accounts receivable instead. All right, so we don't have a lot of new adjustments for merchandising. We do have one, and that is to account for inventory. So just like we had adjustments for supplies when we had them, we're going to have to do the same thing with our inventory. So we know what inventory we had total that we started with plus we purchased. That was our total merchandise available. We know what we should have at the end. But if our books don't match our physical count of inventory, then we have to do an adjustment. So if we were short, that's called shrinkage. If we were over, that's called an overage. So if we have shrinkage and we were short inventory compared to what we had on our books, we are going to write that off by debiting cost of goods sold, the expense, and crediting merchandise inventory. And that would adjust for that $250 shrinkage. The next part looks at closing entries. So for our closing entries, we are going to have just a couple of changes. So our revenue account we're closing is no longer service revenue. Our revenue account we're closing is called sales. We're still going to close sales the same way. It's still a revenue account. So to close it, we're still going to debit it. But we just have a different name for what our revenue is now. The other ones that we're closing is we have a new expense account that doesn't say expense, that cost of goods sold. It is an expense account. And then we also have 2 contra revenue accounts. Because they follow the same rules or the same normal balances as expenses, we're going to close them with the expenses. So we're going to add in not only expenses, we're going to add in sales discounts, sales returns and allowances into that temporary closing entry and close it to income summary. So that's the new part with Chapter 5. All right, next we're going to look at the different format for the income statement. So just like in Chapter 4, we looked at the classified balance sheet. Now we're looking at something called a multi-step income statement. So we're breaking down into different categories. So we're starting with sales. We subtract out sales discounts, sales returns and allowances. That gives us our net sales. We subtract out cost of goods sold, and that gives us gross profit. So that's our gross profit computation. Next, we're going to be looking at income from operations. That's our next line, where we take our operating expenses, and you'll see that they're expanded into selling and then general and administrative expenses. And we're breaking them down into different categories so we can analyze better. That gives us income from operations, and then we still see our net income after subtracting out those other things at the bottom. A single step is what we saw before. We just list our total revenues minus our expenses to give us our net income. But we're going to be using the multiple step income statement going forward. For the balance sheet, the only thing new is we're adding in that merchandise inventory account. So no new process, we're just adding in another asset. Merchandise inventory is listed right after accounts receivable because it's considered to be more liquid than supplies would be. All right, next we're going to look at the acid test ratio for Chapter 5. All right, the acid test ratio is calculated by taking quick assets divided by current liabilities. All right, well, what is quick assets? Quick assets are cash, short-term investments, and receivables. So we're taking those three things, adding them together, and dividing by current liabilities. Typically, we want to have a ratio of at least 1 to make sure that they're able to pay the current liabilities with the things that are likely to be converted to cash very quickly. Here's an example for acid test ratio for Nike, where they're adding up the cash, short-term investments, and receivables. They're dividing by current liabilities, and they're getting an acid test ratio. They are able to compare it to Under Armour's, which they have here, to see, and again, a higher ratio is better for acid test ratio. The next one is the gross margin ratio. Gross margin ratio helps us to determine profitability. So it's calculated by taking net sales minus cost of goods sold divided by net sales. So we're taking our gross profit, net sales minus cost of goods sold gives us gross profit. So gross profit divided by net sales is going to give us our gross margin ratio. All right, that sums up Chapter 5. So while it may not have been a long PowerPoint presentation, there is a lot of new information. So make sure you take your time as you're going through the practice exercises and the Smart Book, and remember also to take a look at your project. All right, thank you, and we will talk soon.